being put into circulation by the central authorities should be so handled as to maintain over long terms of time a stable value. Instead of this, one can observe, in the context of the popularity of Keynesian orientation, that it's considered extremely undesirable that there should ever occur a period of deflation where wages and prices might be forced to decrease. But the continual inflation is an acceptable consequence of whatever actually causes it under the effective circumstances of the actual management of a national money system. Now, I think I should skip off because some time is passing. I'm talking more about the good possibilities and everything, but there's a complication I noted in relation to Greece when I was talking very similar in Germany, a financial meeting. Some kind of inflation targeting leads to the possibility of the evolution evolving to an ideal money, but maybe not. It depends on whether the inflation slows down or slows up, more or less, or slows down or speeds up. Now, I have a lot of discussion about what could be done, but I had some specific remarks relating to Greece, which turned out to be prophetic in a sense. Transitioning to a more ideal form of money. There can be injustices naturally arising if one conventional norm is being replaced by another in a society. Now, suppose, for example, in Greece, that a homeowner or landowner had acquired mortgage indebtedness extending for a period of 30 years with the personal expectation that the value of the drachma involved in measuring his debt before the adoption in Greece of the euro would decrease at the rate of, say, of 5%, at the rate, say, of 5% per annum, in comparison with the value of non-paper assets like land or gold. Then, under a comparatively sudden transition to the use of the euro instead of the drachma, he or she might be in a situation of expecting only a decrease in the value of the unit of the measurement of his or her mortgage debt at the rate of 2% per annum. So the indebted landowner in these circumstances would be suffering a hardship, if not an injustice. And we can raise the theoretical question of whether or not a scheme for reforming a traditionally weak currency, like the drachma, or the lira, or even more so, of course, the Turkish lira, for reforming a traditionally weak currency should incorporate any special features to make it perhaps more just in connection with the relations between debtors and creditors, specifically in connection with debt contracts dealing with long times of projected debt and payment. And here also it is apparent that a government of a state itself, like Greece, would likely have large indebtedness over long terms. Well, now Greece definitely has large international debt to the European Union, the monetary fund. If there were to be a reform of the national currency, then should the owners of 30-year bonds get a sort of windfall of benefits, like if there were 30-year drachma bonds. And this category of bondholders at the time of currency change might be largely composed of speculative holders. So here, there may be technical problems that a scheme of reform could be designed to handle in a manner requiring, for justice and other values, some procedures differing from the simplest imaginable. Possibly in Argentina, their currency board experiment was set up in too simple a fashion in relation to some of these possible issues of justice and equity. One obvious solution for these problems of equity relating to debtors and creditors would be to have, somehow, a system that would gradually phase in a version of ideal money, while some sort of typical 20th century money would be gradually phased out. And of course in Europe they could maybe somewhere phase in the euro gradually and phase out maybe the Polish zloty gradually. I don't know much about the zloty, I don't know what their reputation has been. There's also, one could think even the ruble. Well, and if the US dollar were involved, there might be some use of the already existing TIPS bonds, Treasury Inflation-Protected Securities. These seem to have been in existence maybe about 10 years. I saw some statistics recently that suggested that if someone had a retirement account with TIAA-CREF, which handles academic pension academic retirement plans, if they had the protected bonds rather than the ordinary bonds over that time period, they would be better off. This is an optional type of treasury security. Now here's some other things that relate to money. Insurance, and I skipped some stuff back there, but insurance companies, commercial banks, and state banks. It can be difficult psychologically for good patriots to appreciate the comparison, but state banks, or whatever issues the money used in a state or a group of states, are logically comparable to good or bad commercial banks, or to good or bad insurance companies. There are something called credit default swaps, I think may relate to that. And it is observable that internationally operating commercial banks or insurance companies can be favored by being based where the conventional money is of relatively higher quality. The same principle also applies to the business of investment banking, which is a differentiable specialty function of commercial banks or other financial companies. Savings institutions, and savings rates. Another area where money quality is very relevant is in relation to the savings rate. How will individual decision makers behave with regard to options for thrifty or more spendthrift behavior? It is arguable that the larger classes, in the sense of economically differentiated population strata, should be able to employ thrift options that are not extremely complex in character. And if the quality of the money is really good, then it's simply to save in terms of the ordinary medium of exchange is at least a practical first step. So thus the existence of good money may naturally promote a higher savings rate. The history of savings banks and credit unions seems to illustrate social and economic developments that occurred during the time of stable money values of the gold standard era. Thus, forms of financial institutions came into existence in the climate of good money, which would not have evolved were the money of an obviously unstable value. The process of capital investment, by means of which enterprises prepare to have the competence for making successful products in the future, naturally relates to the processes recognizable as involving savings decisions by individuals and households. And it can become as if paradoxical when the official savings rate is found to be low, how the investment processes are occurring. Of course, in principle, statistical observations can always be questioned until the questioner feels assured of having found a true understanding of the measures being used. It is apparent, for example, that families on the lower middle class income level may be putting a substantial fraction of the income into the gradual acquiring of the ownership of a house that can possibly later on be worth more in money than the money cost of its acquisition. Investment strata theory. There is a classical or traditional concept that influences investment decisions by run-of-the-mill investors and which ultimately derives from the history of varieties of money which seemed, at least for a time, to have relatively stable value per unit of currency. So middle-class investors are often advised by their investment advisors to invest conservatively when they become older and have presumably reduced life expectancy. There are traditional concepts of safer or more speculative channels for the investment of savings. If a counseled investor seems to have a reduced life expectancy, then typically this investor will be counseled to invest conservatively, perhaps in government bonds, rather than speculatively, like in land or commodities or stock market issues. But this standard variety of advice could be very bad advice if the domestic money were like the money in Argentina or Thailand or Zimbabwe during the times of recent national currency crises. Should conservative investing be possible? Here there is a related question of issue of social policy or good social policy. If there can be practically a question of good or bad concerned with the availability of investment options. It is not simply an issue concerned with options to be available to individual human citizens or residents. We can observe that provinces, municipalities, or institutions deriving from these may have needs for investment. These needs may derive from assets which are acquired at one time, as they are there in the print, but which are expected to be spent gradually over future time. The differential strata, if they exist, are money usable as a medium of exchange. Let's see, what is my time? I guess I have some time. I'm very near the end.
About 10 minutes.
The differential strata. A money usable as a medium of exchange obviates the comparative complexity of transactions needing to be achieved by barter. And beyond that, a money with a respective stability of value provides a basis for the practical simple means of achieving storage of wealth, which could be of great practical value to institutions or other entities that need to preserve reserves or assets over time periods of gradual expenditure. In principle, a corporation operating in one country could keep its reserve assets in an exported form. For example, Toyota, operating in China, could keep all its reserves overseas in yen rather than in RMB or yuan currency accounts or bonds, etc. But if the yuan of China seemed to have as much basic stability of value as the yen, then wisdom might dictate another course than